This is Shilpa Raidas, and welcome to the Midweek with Indiacharts. We are here yet again with our awesome Jay Vora. Jay, how are you doing today?
I'm fine. How are you?
I'm doing very good, Jay. I'm very excited to hear your perspective, the analysis that you present so awesomely every week. And I am going to quickly get to my first question, Jay. So today we have an important Fed meet. Will we see a rate hike or not? And what is it that you are looking out for in today's speech, Jay?
Sure. So before that, we will take a step back and we'll see how the data has come out for the US in the past, last few weeks. So when we see the core PCE, that has been slowly coming down. If we see core CPI, that has been slowly coming down. So basically the data which the Fed watches out for, so those are all falling in place. And this is something that we had told last time as well. Okay. So it is just that in the last, this month's data, the non-farm payroll, that data was very high. Okay. Which means that the job openings were very high, which means that the economy is still doing very well. And that is not something that the Fed would want. Okay. Because they are trying to slow things down to bring, inflation under control. But however, the silver lining over there is that the average hourly earnings, that is not shooting up significantly. So that is the good part, which means that the job openings are there. Okay. But the wage growth, the pace of the wage growth is not so alarming, which will make the Fed uncomfortable. So that will keep again the inflation in check. So apart from, whatever I could read, apart from the non-farm payroll, I don't think there are any other data points, that would be very worrisome. The only problem is that the pace at which they are declining, that is something, the Fed would have expected. Okay, the decline should have been a lot more faster because, now they have done, I think rate hike is done for, I think more than 1.5 year. They had started hiking the rates. Okay. So the effect should have come to the economy, and it should have slowed down the sector significantly, but that is not the case so far. But like I said, we are seeing that declining pace. The growth is actually becoming slower and slower. And in fact, yesterday Canada's GDP had come, so now they are technically in a recession because they had two negative back-to-back GDP quarters. Okay. But somehow, in US this time, the GDP data was, above the expectation. But yes, broadly, if we see the underlying things, it seems that, things are slowing down. So now, the entire question is that, whether wo ek aur rate hike aega, nahi aega, and what will the Fed do? So my best guess is that, and I think most of the market participants are betting that there won't be a hike. I think they might keep they might keep a room for one more rate hike, depending on the data. Okay, but more or less we are done hiking. Now the bigger question over here is that will this rate hike, which they have done it, and what the Fed fund is. So will they keep the rates higher for longer? If they keep, then definitely, things can get screwed up. Okay, so that is where, people are anticipating that the cuts by the Fed will be a lot more faster than what Fed is actually saying. Okay, and usually, in the last episode we had spoken about yield curve inversion, which is now started to steepen. Okay, so the point is that if the 2 and 10 year, it goes above the zero line. Right now it is at -15, -20, -15, -20, around that range. But when it gets positive, that is where, usually we have seen a recession, and that is where usually something breaks. Now, what will it break? And what will be the magnitude of that we don't know. Okay, but that is something that we have to be very mindful of. And that is why, in fact, when we had spoken that we are turning our stance for the Nifty index as well and the Indian markets as well, the thing is that we don't know the extent of damage that can happen, but there are risks that are there in the market now. And we have to be very mindful about that. So the one thing that we will be watching very closely today would be what the Fed speaks. Okay, whether the undertone has softened a bit or no, or do they still maintain that stance that they will keep the interest rate higher for longer? Because if higher for longer is mentioned, which I think probably they will mention, the market may not necessarily take it in a good way, but market also knows that in 2021 they said that they won't hike the rates, and in the history मतलब ये सबसे fastest rate hike हुआ है. Okay, so that has been the flip from the Fed in the last 2 years. So nothing stops them from flipping this time as well. It is just that they want to keep that stance, that higher for longer. But if something breaks, or if US significantly slows down, then they'll have to cut the rates, and that is what actually the market will watch out very closely for.
Okay, well, so Jay, we had a monthly close yesterday. Any key perspectives there?
Yes, so actually the monthly close has not been so good, especially for the Indian indices. And I'll share the screen. So firstly, when we look at the US indices, so when you see Dow Jones and when we see the monthly close, okay, what is happening over here is that, in fact, in Dow Jones, I think in the US, Dow Jones was the only index where we basically saw a negative crossover. Okay, now negative crossover means that typically it will go down in the days to come, and probably even the lower band, which is around this 30,188 mark, that may also get tested in the days and the weeks to come. So Dow Jones index specifically has given a bearish crossover, but when I was looking for the other indices like Nasdaq 100, we don't see a bearish crossover, but it is rolling down. Okay, and it is basically rolling over. And also, if we see, a lot of important trend lines are specially broken in the Nasdaq index. So for example, if we draw this trend line, it has broken. If we draw this trend line, that was broken, but now it is trying to come back. So important will be, whether it tries to close above the daily averages or no, that is the 20-day average. That will be very important. Then if we see S&P 500 over there as well, if we see the monthly close, then the monthly close was negative, and again it is rolling over, but we are not seeing a bearish crossover. But at the same time, there has been this trend line breakout, which if I show you on the daily chart will be a lot more clear. So there has been this trend line breakdown, which we have seen in the S&P 500. And also over here, there was some sort of throwover in the near term, which was, basically the break of the trend line, and now it has again come back. But again, over here, closing above the 20-day average will be important. If at all, it has to see a bigger bounce in the near term. But, one needs to understand that if there has been a correction, there will be pullbacks that we will get from time to time. But it is important to understand that what is happening on the larger time frame. Okay. And on the larger time frame, it seems like this was one decline, and this pullback is now more or less looking like a corrective pattern because it has overlapped the previous high. So in Elliott wave, it becomes basically A, B, and C. Okay, the only way it can be bullish is that if people count it as 1, 2, and 1 and 2 again. Okay, so this thing also can happen, but given where the yield curve inversion is and putting that into context, I think the count of ABC is a lot more appropriate at this point of time. Okay, which means that if this is a counter trend rally, then there can be two outcomes that we can see. Basically, S&P, consolidates for a long time in this range, or what ends up happening is that S&P actually sees a sharp decline. Okay, and this either becomes W or wave A, this becomes X or wave B. Sorry, this become X or wave B, and now what is happening is either wave Y or wave C. If it is wave C, then it will be very sharp. If it will be wave wide, then it can take its own sweet time and it can come down. But basically, the outcomes that we are seeing is not so positive. Okay, and that is why we are bracing ourselves for a correction, especially also for the Indian indices. Now I'll come to the Indian indices, but like I said, Dow Jones is the only one over here which is seeing that bearish crossover. Apart from that, all are now rolling over. They haven't seen a bearish crossover yet. It is the US small cap index, which is also known as the Russell index, the Russell 2000. So that has completed a pullback cycle. Okay, it formed a triangular sort of structure over here, and it is now breaking down. Okay, if we get a confirmation of a bearish crossover, wherein the monthly RMI turns bearish, then that will be negative, and a big decline can be seen over here. Basically, then this might end up becoming A, B, C, or again, like I mentioned, it can be W, X, or Y. Okay, what does it happen? We need to see, but yes, surely this chart is not looking good. So this was on the US indices. Now, when we look at the Nifty index, okay, so first we look at the Nifty index over here. Wait, let me remove the drawings.
Yeah.
So over here, see what has happened is that on this particular close, it has not given a bearish crossover. Okay, so basically, if I see the value of RMI, so it was about to get in sell mode, but it hasn't got in sell mode yet. It is only if this month the Nifty index closes lower, then most likely it will get in a sell mode. And if it gets in a sell mode, then there is a risk of a correction. Okay, so basically the first level that would then come to our mind is basically the 20-month average. Okay, which is say right now around 18,050 kind of level. And if 18,050 is then broken, then that's where a more scary scenario can play out. But there is one important thing to note, that when we look at the Nifty index, so when we look at the weekly chart over here, so as you can see, this blue line is also a very important support. Okay, so which last week got defended, and from there we have seen a 500, 400 sort of points sort of bounce over there. But if the Nifty index breaks and sustain below this blue line, that is where in the near term, things can get a bit problematic. So to summarize, the Nifty index is at a very crucial support level. Okay, it has not broken that. But given that the Dow Jones is already weakening, I mean, the US indices are already weakening. So we are anticipating that eventually, weakness will creep in the Indian indices as well, and specifically for the Nifty index as well. Okay, so that is basically the risk point. But as we had mentioned earlier as well, that we don't want to mention any levels. Okay, we'll go by once the level breaks, and we'll consider what are the downside levels next that we should watch out for. Okay, so for the Nifty index particularly, if we consider this entire move as one rise, okay, so what we have to do is that we have to take a Fibonacci retracement level from the bottom to the top. Okay, so in that case, the level that would work out for the Nifty index will be 18,525. So this is valid if the blue line, which is say right now around 18,873, okay, if that is violated on a closing basis, on a weekly closing basis, then on the downside, 18,525 and 18,120 sort of levels will come into play. Okay, so that is on the Nifty index. Now, when you see the Bank Nifty index, the monthly close over there is very bad. The reason why I say is very bad, because when you see the RMI over here, okay, so it has already gone in a sell mode. So it is not because of today's new monthly candle that it has gone in sell, but last week itself it has gone in sell. And mind you, Bank Nifty is the only index which has gone in sell. Okay, no, the other indices are rolling over like we are seeing in the US indices, but they have not gone in sell mode. Only Bank Nifty is the one that has gone in sell mode. So now, specifically for the Bank Nifty index, the 20-week exponential average, which is right now at 41,080, that becomes extremely important support level on the downside. And if that breaks on the downside, then over there things can get very bad, and that is where we are just trying to see each level at a time. Once if a certain level breaks, then that's where we are going on to the next level. So yes, in the Bank Nifty, given that it's a bearish crossover on the RMI on the monthly chart, so a test of the 20-month average is possible, which, like I said, is at 41,080. Now, when we look at the small and the mid cap index over here, what is happening is that we had seen a runaway rally for 1, 2, 3, 4, 5, 6 months in a row. Okay. So after 6 months of rally, now, I mean, in the last week is when we saw a negative weekly close, negative monthly close. So all the people, who understand our method, basically the color change method and the importance of, the turning, the candle turning from green to red. Okay, they will understand that this entire move is possibly complete. Okay, if that is the case, then like we did for the Nifty index, a retracement of this entire move is possible. So this is the bare minimum case. Okay, what we are watching out for. So the 38.2% retracement is, say, at 37,121. If that breaks, then 50,000, then the 50% retracement, which is at 35,566. Okay, that will open up. And that way, 61.8% will be the level, that can be the worst case scenario if this is just a routine correction. Okay. So the 61.8% level is at 34,012. If the 61.8% is broken in any of the index, okay, be it Bank Nifty, Nifty, small cap, mid cap, wherever, then the bear case scenario will come into play. Okay. Until then, this correction might look like a routine correction. So as of now, like I said, we are not sure whether this is a routine correction or a start of a bigger correction. But the setup overall is there, especially for the US indices, that a bigger correction can kick in. Okay. So that is why what we are trying to do is that we are de-risking ourselves, and we are on the sidelines and we are waiting and watching how the correction plays out. Because will the correction be something of this sort where we keep getting pullbacks, or it will be a straight sharp correction, is something that we don't know at this point of time. So like I said, the magnitude of what happens in US, because like I said, once the yield curve steepens, usually something breaks in US, right? So so what will be the magnitude of that? That will kind of determine how the correction will play out. Okay. So that is why we are being on the sidelines and we are waiting and we are watching. And this similar setup is actually there for the small cap index as well, because even they rallied for 6 months. Okay. And this month they haven't, closed very much downside. Okay, but they have formed a doji. Now, doji again means indecisiveness among the market participant. So if the low of the doji is broken, which is 12,048, okay, so that's where a correction can kick in. So in case of correction, again, we'll look at the retracement levels. So the 38.2% retracement itself comes to around 11,072. So mind you, right now, small cap is actually the strongest among all the other indices. Okay. But if the low of the doji breaks, then that's where there is a risk of furthermore correction. Because, the ones which are stronger, they then become vulnerable for furthermore correction. Right. So that is the risk that we are seeing right now. And that is why we are kind of, trying to step back basically. And, and we are trying to watch how things unfold and how ugly will the things get. Because what had happened was that when US was correcting, okay, over here, and it corrected 20-30% or so. So at that point of time, Nifty did not correct that much. Okay. So will the same thing happen this time around or not? So we are not sure. So that is why, like I said, again, we are stepping back and we are seeing how the correction unfolds. Once we see all the risks subsiding, that's where we'll again be back in the market and we'll again start thinking positively.
Okay, that's very well clearly explained, Jay. Thank you so much. Jay, I would like to ask you, what are the sentiment indicators on strike telling us right now?
Yes. So this is where, actually things get very interesting.
Okay.
Firstly, I had already explained this indicator, which is the daily swing. So that basically measures the momentum of the FNO stocks only, okay, which is 180, 185. It keeps on fluctuating. So if the momentum is rising, you will see the daily swing rising, okay? And if the momentum is falling, then you will see the percentage of the percentage of FNO stocks ka momentum rising is basically this point, okay? So as you can see over here, we had said that the reading has come very low. So there is a case of a pullback. The pullback has come by and you saw this daily swing again, rising higher. Now, the thing is that, is this pullback done? And again, can it go down? Is something that we will see. But yes, I mean, it would be very interesting to talk about the Nifty's near-term setup as well. That is because when we look on the hourly chart, it looks like that this was possibly, a bear flag. And the pullback is done over here. And now we are breaking down from this channel. Now, a similar thing had happened over here. So basically, we saw a decline, then we saw a pullback. And once this trend line was broken, we saw a sharp decline. So will it be the same this time around? That needs to be seen. But the hourly setup definitely is not so good ahead of the Fed meet. Now we need to see, if there is any positive surprise for the market or no. But if there isn't, then Nifty is actually in trouble. Okay. So the last confirmation that I think we will watch out for is basically a break of this low, because then it will also negate the higher top, higher bottom pattern. So once that breaks, so the higher top, higher bottom pattern will also get negated. And, probably we will see the next leg of decline. So yes, so coming back towards a sentiment indicator. So there was a pullback that was expected that has come by. Now the average swing is more of a medium term kind of indicator. Okay. So what it does is that, see, as you can see over here, yeah. So over here, it had gone towards this oversold zone. Okay. Then it bounced back marginally, but again, it fell only to make a positive divergence eventually. Okay. So over here. So now a similar thing can happen over here as well, where a pullback was expected due to its oversold condition. Now that the pullback has come by, okay, there is a chance that, we end up seeing such kind of decline, and where again it goes back to the oversold zone and, probably end up forming a positive divergence. So see, you have to understand sentiment in context of what is happening in the market. Okay. If it was a routine correction, something like this, कि हम ऊपर जा रहे हैं and then we are seeing a pullback, then in such routine corrections, this oversold levels will work very well. But if we are entering a bear market, or if we are entering into a bigger correction phase, so like I will show it over here. So, this was probably one of the chain that we had observed in swing, wherein earlier, if you see, it used to come back towards this oversold zone and it used to bounce. Okay. But it was only around this time that the reading during the intraday went to as low as 3%, which means that in this decline, while this decline was happening, only 3% of the entire 180, 185 stocks ka momentum was rising. Baki 97 ka momentum was falling. So that was telling you the kind of bearishness we had, around that time. So now, like I said, you have to understand the context. Agar wo bear market hai, or if the market is going down basically, then, you will see some sort of pullback from the oversold zone, but again, then it will go down and it will either end up making a further new low, or it will end up making a positive divergence, wherein the prices makes lower low, but this indicator will not make a lower low, and that would eventually hint that the momentum on the downside is losing. Okay, but we are possibly not there yet. Now we are not there. Basically the correction phase that Nifty is in, we are not into that very oversold zone. The reason being, now when we look at the other indicators, like the put call open interest, which is basically smoothened by the 9 MA. So over here you can see at the bottoms, it can go to these levels, or like I said, it will keep forming this positive divergence wherein the prices make lower low, but this will keep making higher low. Okay, and we get a positive divergence, and only then we pick up. So do we get into this kind of phase or this kind of phase? That is something that we need to see. But purely when I only look at the open interest 9 MA, okay, it doesn't tell me that the market is at an extreme. Now similarly, when I see the put call ratio, the volume put call ratio, that is basically the 14 day average, I mean that is what it is smoothened with. Now this chart kind of tells me that the panic is for real, because when the ratio on this line is basically increasing. Wait, let me refresh it. I think something happened. There seems to be some net issue at my end today. Wait, I'll open the tab once again. Yeah. So when we look at the put call ratio, volume put call ratio for the 14-month, so actually this around this time, okay, around this time, this was the highest reading, on record, because Jabi 2008 maybe. So what happens is that when this line is at the peak, okay, that's where a bottom occurs. So you can see over here, no bottom has occurred. You can see over here, over here, this ratio has peaked, the bottom has occurred. Okay, so this ratio rising higher is telling us that there is a lot of fear among the market participants, and that is why the volume that is happening in put is lot more than what it is happening in call, and that is why this ratio is rising. Okay, so I would wait for this ratio basically to touch some line and then roll over, because when it rolls over, that is when there is a good possibility that a bottom could be forming. Okay, so that's why we have to wait for it to roll over and not necessarily preempt. When there is extreme optimism, okay, that's where you will see this ratio eventually coming down and going to as low as 0.43, which happened basically at this top, and it happened somewhere around this top. Okay, so right now technically we are actually in that fear sort of zone where people are continuously buying the puts, and this particular behavior we have actually seen it very different after the 2020 phase. Okay, I don't know, I mean, what could be the reason. We actually also double checked our calculations if we are doing it correctly or no, but we are doing correctly, and it seems that like something has changed over here. So that is why right now we seems to be in a panic zone right now, but we don't know when it is going to roll over. Okay, so that is one thing that we'll watch out for very closely to understand if the market is near the bottom or no. And then lastly, when we come back towards the breadth indicators, that is the advanced decline ratio, which is smoothened with the 20-day average. So that is somewhere in an oversold zone, but it is not in an extreme oversold zone. Okay, and like I said, there can be this positive divergence which can play out before it actually bottoms out. Okay, so we are still far away from there, at least on the near term advanced decline ratio, that is the 20-day advanced decline ratio. And when we look at the 40-day advanced decline ratio, so we are very much far off from there, I mean from the oversold zone. So as you can see over here, the breadth seems to be cooling off. That is because the index had made a higher high over here, but the indicator is not making a higher high, which means that the participation is somewhat narrowing down and the momentum on the upside is losing. Okay, which means that people, I mean, the stocks are more on the declining side during the day, and that is why this ratio is coming down. So again, to say that we are in that extreme fear sort of zone, so we'll see if this ratio comes down towards this oversold zone or no. Okay, and lastly, the most important one, that is the FII's positioning, that you can say that it is somewhat near this oversold zone and probably into that second oversold zone as well. Okay, because now if we see the reading as on Tuesday, so today's Bhav copy is still not updated. So over there, if we see it, then it's 1,57,000. Okay, the short contracts. And in the last decline which we saw over here, so the shorts were somewhere around 1,96,000. So there is still some room over there. Now it can happen that because we are somewhat in an oversold zone, so there will be a minor pullback which can cool off the short position, and only then once again it comes down. That is entirely possible. Okay, but the underlying trend on the price action, that needs to see a reversal. Okay, so we have to look sentiment with respect to the trend. Okay, if something is changing and if the bear market is starting, then initially those oversold zones will not work. Okay, so that is what we are trying to figure out, we are in which phase. Okay, but just to summarize basically, so I'm done with the sentiment part, but just to summarize, US indices are in a problematic zone. Okay, and we cannot be isolated. Nifty will probably outperform the Dow Jones or the US indices. Outperformance meaning, if the Dow Jones fall 10%, then we may fall 3, 4, 5, 6% or something like that. Okay, but it cannot happen that US indices fall 10% and we rise 10%. Okay, so because we are seeing a risk in US, we are very mindful about things can get ugly in the Indian indices. Whether it gets ugly or no, that needs to be seen. As of now, when we see all the sentiment indicators, we are not into that extreme fear zone. Okay, so that is what is telling us to wait, and it is not that there is actually blood on the street. Okay, I mean, despite this correction, we are not entering to that fear zone. So we'll watch, we'll wait, we'll watch out for zones to come, and as and when we see those zone, we will definitely update all our subscribers. So yes, so broadly that's it from my side. So basically India is at a wait and watch mode. US is where the action is happening on the downside, and let's see what Fed does today, and what direction do we get in the forthcoming days and weeks.
Okay, wonderful. Jay, that was very well explained. Thank you very much. So we see that the features on strike are very helpful. Like Jay explained the sentiment indicators today, I'm sure you guys must have been more curious. I would like to leave a link of strike platform on our description. You can definitely go and check it out. Get your free trial right now while you have the chance. Okay. And since you are here, do subscribe to Indiacharts and Strike YouTube channel. Both the links, you'll be finding it in the description as well. And keep updated with our videos as we'll come with more analysis and clarity on the stock market. Thank you very much, Jay. Thank you so much for your time today.
Thank you.
Thank you so much. Bye-bye.